Awesome. So thanks for joining everybody and whoever's watching us afterwards. We're going to open up with the Lucrum Real Estate Group, Ray Rodriguez, the principal and CEO. Ray, you had a pretty awesome and unique interview earlier today, like a Q&A sessions with Howard Jarvis Taxpayers Association, right? Talking about that Measure ULA, the mansion tax lawsuit.
Right.
So give us some insight.
Sure. So just real quickly, as I'm sure most people know here, Measure ULA goes in effect on April 1st, and it's a pretty hefty tax impacting every owner of any kind of real estate in the city of Los Angeles. So it was packaged as the mansion tax, which was obviously misleading. A lot of people didn't realize until it was too late that it impacts commercial real estate as well, not just residential. As we all know, in LA, it's not too hard to have a property that's worth 5 million or more. So a lot of people are going to be affected by this. And as it stands, if you close April 1st, you're too late. Like you're paying the tax. So you actually need to close prior to April 1st. Which we can still do. We're actually helping people right now get escrows closed quickly that want to dodge that tax. Now, what was super interesting is that, as I was saying to you guys privately before we opened up the room, as in the real estate industry, we tend to not be active participants in what's happening around us because we get really locked in and focused. And if we're brokers or agents, we're selling real estate, or if we're investors, we're busy managing real estate. And all these different laws in the state of California and the city of Los Angeles, meanwhile, that impact our industry are being passed and affecting us. And then we hear a bunch of moaning and groaning and complaining, but no real action. And the great thing is there's groups now that you can support, such as the Howard Jarvis Taxpayers Association, that are teaming up with other groups, such as AGLA, which is the Apartment Owners Association in Greater Los Angeles. And they're actually, in this case, they're suing the city of Los Angeles, is what we found out on today's phone call, which, to be honest with you, I wasn't even aware of for up until about a week ago. And the big takeaway was that they're suing based off of the fact that it's actually not legally valid to begin with. There's pre-existing law that they are citing to frame their argument. So they feel confident that they're going to get this potentially thrown out based on the fact that it was never legally valid to begin with. And in addition, CoStar just put out an article that enough signatures were obtained to fight and actually get a new vote on this. But that's not going to occur until like 2024. I don't have the exact date in front of me. So the big question was, hey, that's all great. Like, you guys are awesome. Everybody should support you. And I mean that, like, that's true. Like, Google them. You can participate in a lot of different ways. Is cheap as just being a member for $15 a month. And then, of course, you could donate more past that. That's exactly how they fight these lawsuits. It's all donation based. So they're being backed by some pretty big real estate people now. But that's really how you fight against this. And the takeaway was this. I said, look, guys, awesome, you're fighting this fight. At the end of the day, really what people want to know, outside of the fact that they now can support somebody like you, a group like yours, is what's the reality of the situation right now? Like, as real estate investors, as real estate agents and brokers, we're always trying to set expectations, accurately so we can plan accordingly. So the reality is this, is although they feel like there's a really good chance to overturn this, that happening prior to April 1st is low probability. It's not impossible, but it's low probability. So what we need to do is plan and set expectations with clients that they will need to be prepared to pay that tax. It doesn't matter if they're upside down on the property. It doesn't matter if they're losing money. It doesn't matter at all. If it's in LA City, and it's worth 5 million or more, they're subject to that tax. The transfer tax comes out no matter what. Now, the positive note was, and it came near the end of the meeting, was that, Manny, I can share the meeting with you, and you can share with the group, and I can share the specific document or form that they cited, but they're advising, which means now we're advising, that anybody who closes and gets impacted by the tax immediately file this form, to be cited later, that would then actually allow them to be credited their money back, that was taken for Measure ULA if it's successfully overturned. So that was a positive, right? Like that's exciting. And it's one of those things where, as real estate agents or brokers or investors, there's like anything else, they're like, hey, just do it right after you close, because you're able to do that. And then if it gets overturned, you can get your money back. There are some other, like, things that they dived into, but that was the really, as far as we're concerned, is people and, selling real estate, that was the big takeaway from my end.
Yeah, and thanks, Ray. That's a really good kind of bullet points, right? Like just highlighting the meeting itself. Kim, can you spotlight me, please? So a quick question for you. Do you think, or I'm not sure if they mentioned that or someone else spoke about that, do you think it's going to affect any kind of principal motivation to sell right now until it's going to get a bit clearer of what's happening, or especially if it's like the high price point across the 5 million over there, it's it's
right,
substantial.
Right. Yeah, so it is definitely impacting velocity of transactions, right? Like we're going to see less transactions because of this, like plain and simple, because who wants to pay 4% or 5, whatever the other one was, once you get north of 10 million. I'm sure somebody knows the answer to that, could put in the comments. I don't remember right now, but there's basically 2 different percentages that we're going to pay. It's a lot of money. So really what you have right now is you have the groups that, it's kind of late to the game to tap into them, but you had to be ahead of it as soon as it passed. But you've got the groups that are looking to sell before and close escrow before April 1st, right? They have to close the end of March to not get to not pay this tax. So you've got some of those clients. We were fortunate enough to pick up some of those clients to help them sell prior to this going into effect. However, everybody else that we're talking to, this was a big hindrance for them. It kind of kills a lot of the motivation to sell if you're not in a situation where you need to sell. So we're always looking for kind of the big ones that are motivators: death, divorce, taxes, partnership breakups, disputes, things like that. Just the reality of our business. Mm-hmm. So unless you have like a really high motivating factor, this was a huge reason not to sell. And it's going to continue to be a big reason for people not to sell if this actually does stay in effect. So we're expecting a lot less transactions once this goes into place. And then the timing of it, for us in the business sucks, because we're already fighting against interest rates on the rise, and that takes a lot of the wind out of the sail for people. So it's just the reality, though. I mean, it's the reality of the market we're in.
Yeah. Any questions for Ray? Well, we have,
that's for LA City. So if it's not LA City, you could be in LA County, right? But like, let's say you own a building in West Hollywood. Like we have a listing in West Hollywood right now, 16 units, 4.66 cap. And a property like that, because it's WeHo property, not LA City, will not be affected. Mm-hmm. Thank Lord on that.
Thanks for clarifying. Yeah, for sure.
Yeah.
Any questions for Ray while we have him on the call? Anybody? And Ray, feel free to share whatever you want. And thanks again for the open invitation for everybody for that session. By the way, is your session recorded? We can share that recordings by any chance, or?
Yes, I can send you and Kim the recording probably tomorrow. Okay, great. We got a request for the Howard Jarvis Taxpayers Association, I think so. Yeah, Kim, maybe you could send them.
Yeah.
a link to their site.
Yeah. Phil, anything you want to add?
Yeah, I want to ask Ray a question. Ray, I kind of put a mock thing together, a flyer, and talks about, what it is and the different cities that are affected differently other than just LA City. Could I email it to you and you can take a look at it and you tell me if it's right on, spot on? And I want to make sure it's very accurate.
100%. Yeah, definitely.
Yeah. Maybe Kim can shoot me your email address at the end of our time together here.
Sure. Yeah, I would just, to close out my little section here, I would just encourage agents and encourage investors to, participate in these things, to stay informed. And as real estate professionals, you do not have an excuse to not advise your clients if you're taking a listing. You better be pointing this out. You got to get an estimated net sheet, turn it in, because I promise you, there's still a lot of people that are in the dark on this. And if you're in escrow to close April 1st or later, and suddenly your client's like, what is this? And you're like, oops, we're going to probably see some liability things coming out of this too, because they're going to expect you to be a professional and to know and advise them. Yeah,
Ray, good point. I mean, what it is, it might be your commission, right? So,
well, it's gonna be more than your commission. I mean, in some cases, you get into the $5 million range. And take 4% of that. In a lot of cases, that's going to be more than the commission being earned.
Yeah, it's big numbers. Yeah, and we did share that those Howard Jarvis Taxpayers Association link on the chat. Ray, awesome, man. Thanks again for sharing that and for doing this on behalf of Lucrum, your group.
My pleasure, guys. Thank you very much.
Thank you. And from if not selling, exchanging, it's a great segue to Phil Atwan, our 1031 exchange expert. Kim, do you want to spotlight? Ray, thanks, man. Appreciate you.
Mm-hmm.
Phil.
Hi, everyone. Kim, hello. And thank you for bringing me back here. I want to sort of do a very quick highlight and kind of go into some of the other issues we sort of left off last time. I got to tell you, of all the times that we have done this, last time I got more emails and calls where people were asking thank you, saying thank you, and could I get some of those marketing letters? Because folks, the key to 2023 is going to be getting in front of people, right? And the more we get in front of people, the more opportunity we're going to have to be able to develop the relationship, talk about releveraging the equity, because if these folks have had title to their buildings for 12 years or longer, they probably have equity unless they refinance it out. And the higher that equity is going, the lower the rate of return is going down, because they can't charge more rent or lease payments because they have more equity. So the rate of return goes down. So that's why getting in front of these folks, and whether it's a residential income building, or whether it's a skyscraper in downtown LA or anything in between, the bottom line is any kind of commercial, industrial, a building, gas stations, car washes, storage facilities, whatever it happens to be that you're looking at, laundry, retail centers, office space. I mean, the higher the equity, the lower the rate of return. And that's why doing this 1031 tax deferred exchange will allow them to leverage the equity by taking the money out of the sale and reinvesting it into other properties. And let's face it, these people are going to other states right now. I mean, since the pandemic, as one of the largest independent exchange companies in the country, I have watched the exodus of investors in California go other places. Where are they going? They're going to Florida. They're going to the Carolinas. They're going to Tennessee. They're going, in fact, I got 2 calls in the last 2 days, believe it or not, from Oklahoma. I'm getting calls, Texas, they're wanting to go to Texas, Arizona, Nevada. They're going to places like, believe it or not, Utah. They're going to Idaho. Idaho's been kind of big for a while. And they're just moving their assets around into other states, just to mention a few. And there's no reason why you can't get in front of them if you know who they are. And the equity thing, the higher the equity, the lower the rate of return. Well, the people who've owned those properties for 12 years or longer are in a position to leverage that equity, get higher cap rates. And the other thing I think is really important, and I know that you can comment to this, you know, the law in California, and especially in LA County, they favor the tenant, not the owner. And the bottom line is it's getting more radical or crazy, as many said it earlier today, in terms of law and these supervisors and the county officials and even the governor and all the legislature are more and more and more consumer protecting, anti-owner. And that's why folks are leaving, not to mention the cap rates, not to mention the increase in rents, and not to mention you can go with multiple buildings and buy for the same amount that you sold for here into other places. Triple net is a big deal right now. If you're not talking to people who own 4 units or more, those who've owned for 20 years or longer, those people's hair is my color. Yeah, they're getting older. They want to retire and they do not want to stay married to the tenants. And they're very attractive by having a Starbucks or a Wells Fargo or a Trader Joe's or whatever, you know, the anchor tenant is. It's just a great move for them. And they can be out of the management business, but not out of the real estate business, completely defer their taxes and go into other places where, you know, maybe the management is paid for the property taxes, their insurance on the building, they're paying for the maintenance and the upkeep of the building, whatever it is, double net, triple net, whatever it happens to be. I mean, there's a lot of opportunity for these people right now who have a lot of equity here, who are looking at or are in retirement. What an opportunity for them to move their properties other places. Why do I know that? 2 reasons. Number one, I get the calls. They're calling me because they want to talk to an exchange person to see how this works. And number 2, honestly, I'm an investor and I look at things like this. So, you know, and I've been doing this for, well, almost 41 years. You know? So the bottom line is, you know, let's talk a little bit about what we sort of left off with last time. Remember, if they can increase their cash flow by getting a higher rate of return, that would generate more monthly income for them because they'll have more doors or bigger doors that are paying them rent. That's a good thing for them. They also are looking for appreciation over time. That's a motivation that's already happened to them. And to go into other places where people from California have been going to, or New York or other high state tax places, those properties continue to appreciate. One of the most interesting markets that's out there right now that I did not mention to you before is the state of, you'll never believe this, Ohio. Ohio is growing. It's turning, and they're having places like in Cleveland. It's becoming the new Silicon Valley of those areas. Businesses are moving there and values are going up as a result of that. So good appreciation is a big factor into this. And remember, when you re-leverage equity and you buy up, you create additional tax write-offs because you start another layer of depreciation based on the portion that you acquired up in. Remember, commercial's a 39-year depreciation schedule, residential is 27.5. It's based on the what? The improvement of the buildings, right? So the bottom line is a depreciation, buying up creates more tax write-offs, which reduces the amount of income tax they pay on the rent or the lease payments they're receiving on a monthly basis, an annualized basis. There's a lot in it for the investor to look at when it comes to relocating those buildings. Heck, I don't know if I told you last time, I get calls from investors like with industrial properties and commercial buildings, and they want to keep it in California, but they're taking it to Ventura County or to the Inland Empire, where they have less of the tax burden. And they are willing to sell and buy to do that. And when they do that, they're going to do a 1031 tax deferred exchange. Remember, the bottom line is that income is the name of the game, especially. Last time we talked about re-leveraging the equity. We don't have to go over, we sort of already did that already. You don't need to do that. Current tax rates, if they just sell, we're talking 15 to 20% long-term on capital gains to the IRS. But in addition to that, they have to pay the Medicare, healthcare, Obamacare, affordable healthcare, I don't care what you call it. They pay an additional 3.8% over $200,000 gain. That's another one that was passed on us. Number 3, California today is between 9.3 and 13.3. Well, since I spoke with you last, California has finally admitted we are in the red right now. They are losing revenue. Taxpayers are leaving the state who have high net worth. And those high net worth people pay the 50% of the taxes for the state of California. They are talking again about raising the #1 state tax in the country from 13.3 to between 16 and 18.3%. And we're already the industry, the country leader at 13. So the bottom line is investors can defer that as well in a 1031 exchange, not to mention the 25% recapture depreciation tax. Remember, that depreciation is going to be charged upon the sale based on the amount of allowable depreciation your investors were allowed to take. And if that is the case, and they did not take the depreciation, guess what? They still have to pay the recapture tax, whether they took the write-off or not. This is what your clients pay when they do a 1031 tax deferred exchange. It's for the purpose of growing your portfolio and taking it to better places that are going to be better for them. Remember too, if they have the property in an LLC and the shareholder of the LLC is a trust, or they just have properties in a trust, which kind of some people just do, and I'm not sure why they do it that way, but the bottom line is when they pass away, the surviving spouses and heirs are entitled to a stepped up basis. So maybe they bought originally at 300,000 and now the asset's worth 5 million. It steps up to 5 million or whatever the value is at the date of death. It's an incredible deal, folks. That was passed by the government in 1954. So the government has some real benefits to selling and buying and keeping it in an investment property. And remember, last time we also mentioned what is the definition of investment real estate? There's only 3 properties that qualify, and that's it. It's either being rented and held for monthly income. It doesn't matter if it's residential or commercial or industrial. Number 2, if it's not held for income, it is allowed to be an owner user. So if it's an owner user and they run their business out of the place, it qualifies for a 1031 exchange. Or number 3, vacant land. Vacant land after of any of these 3, as long as it's been held for 2 years or longer. CPAs won't argue 2 years or longer. Under 2 years, they tend to argue with as to how long you should own it before you can sell it and do a 1031 exchange. All 3 of these qualify. But the big question is, if I'm going to do a like-kind exchange and I'm coming out of an industrial building and I want to buy a 3-unit residential building, is that like-kind? The answer is yes. Why? Because the definition of the exchange is the sale of what? Investment real estate. And all 3 of these are considered as investment real estate. It also means you can go back into any kind of investment real estate. So if you want to sell that industrial building and buy, a 2-unit, a 3-unit, a 7-unit, a 12-unit apartment building, you can do that because that is the sale of investment real estate into the purchase of other investment real estate. That's an incredible deal. And that means like kind. Do you realize the opportunity out there for some of these investors who are rethinking their portfolio and they want to go into something else, somewhere else, that you can be the listing agent on? And if they're buying out of area or whatever, you can get a referral fee by helping them move those properties around. Let's go into this one. Remember, when you do this sale, you want to, if you're not using the AIR form, you're using the CAR forms, you can definitely use the SXA form. The SXA is the seller's intent to exchange addendum. It does 2 things. Number 1, it allows you to be able to do what? To be able to bring in the accommodator. You have to have that in writing, or escrow has to do an amendment. But I like this form, the seller's intent to exchange addendum. Why? Because under number 4, you can write in contingency language. What kind of contingency language? Well, once the sale closes, you know you have how many days to identify a replacement property? 45 days. How many days to close a purchase? 180. The 180 isn't so bad. It's the 45 days of identification in a marketplace where there's not a lot of inventory. What this allows you to do is basically negotiate with the buyer to say, look, I'm going to at least go for a 30-day extension to our agreed escrow period and take that 30-day extension and maybe extend it again, or however you want to negotiate it or word it. But the bottom line is it allows your client enough time to make sure that they can find and get into escrow on an upleg, on a replacement property. That is really important. Remember, this happens 3 times a week, every week to me. I get phone calls. I want you to look at the red at the bottom. The people call me up and say, I need to do an exchange. And I say, sure, where's the escrow at? I'll contact the escrow company. I'll get it set up, or the attorney or the title company, whoever's doing the escrowing of this property. And they say, well, we closed yesterday, or we closed last Friday. It's too late, friends. I tell these people, I'm sorry, I cannot help you. The government forbids it at this point. So the bottom line is that this exchange has to be set up before escrow closes with a company like ours that's going to facilitate it. And remember, don't forget this SXA form. When you buy the upleg and you want to put an offer in on it, you want to use the buyer's intent to exchange, the BXA upleg. That just tells them basically, we have an accommodator, our buyer's doing an exchange, the accommodator's holding the funds, and we will even give to your client a verification of funds letter so they can give it to you as you're presenting your offer to the upleg. That's not a problem. Remember, there's different ways of doing this exchange. We just kind of alluded to this simultaneous exchange, 180 days to close from the time the sale closes. 180 days to close what? Their new upleg, their new replacement property or properties, because they're not limited to one property. Number 2, they have the 45-day identification period. What does that mean? That means in the first 45 days, under the 3-property rule, they can have up to 3 properties on this identification list. And once you pass the 45th day, you can't change the list anymore. Those are the only properties you could acquire. And if the government gets wind that something has changed, then there's a problem. It's called tax fraud. And now it gets really ugly. By the way, FYI, and I hope everybody's listening to this part, the IRS has given, in some cases, extensions to the 45 and or the 180 days if you were affected by the recent rainstorms. They are allowing for 2 different types of extensions, of which your taxpayer client, the owner of the building, needs to confer with their tax counsel to decide, number 1, if they qualify for the extension, and number 2, if they qualify, and which one of the 2 options they're going to take. We do not want you to explain that to your clients. They don't even want us to explain that to our clients. It's complicated. It's vague in some areas, and we want the CPA to choose what would be best for the client, assuming LA County is a state accounting under the IRS's memo. So what we'll do is, if you want, send me an email, and then, or I can send it to Kim, and then she can distribute it to all of you, what it looks like, and the website to go look at for the IRS, and for the CPA to make a decision as to whether your client qualifies for this extension or not. And there's 2 different extensions, so I can't even give you times. But your CPA really needs, their CPA really needs to give them that approval.
Phil, can I
Yes.
ask you, can you explain that 200% rule?
Yeah, I'd be happy to. I'm glad you stopped me. The 200% rule says this: you don't want to identify 3 properties. You need to identify more than 3 properties. Why? Because you're buying most likely in other places. You're going to go into ag land, right? Or you're going to buy a farm, or you're going to buy a ranch, or you're going to buy in other areas or other states where the values are lower. And since you're selling for a larger amount, it might be difficult to acquire just one building, or you want to diversify into those different types of properties I just mentioned. So what happens is, in those cases, the government takes you out of the 45-day 3 property rule and puts you into the 200% rule. What does that mean? Under the 3 property rule, you can have up to 3 properties at any given time. You can take properties off, put new properties in, but after the 45-day passes, that's it. Those are the only 3 properties you can choose from. The 200% rule is different. The 200% rule says you may identify 4 properties or more. There's no limit to the amount of properties you can identify. When you identify a property under the 200% rule, many times it may not contain an address. So you could have 1 of 3 descriptions in there. Number 1, an APN, a tax parcel number. Number 2, a legal description. Or number 3, an actual address with specific unit number and designation for that particular property. You can identify 4 or more, but under the 200% rule only, not the 3 property rule, but the 200% rule only, not only do you have to identify that location of that property, that specific address, but you must also identify the fair market value of that building or that land. And the bottom line is, when you identify that fair market value with each property, 4 or more, whatever you're going to identify, the total value of all those properties you identify under the 200% rule cannot be more than 2 times the price, the gross price you sold for. So if you sell the building for $4 million under the 200% rule, yes, you can identify more than 3 properties, but together, since you sold for $4 million, total impact of all the properties you identify may not exceed $8 million. That's why it's 200%. It's 200% of the sales price. Please do not get confused with that as it relates to the 3 property rule. There is no value limit under the 3 property rule. If you sell for $4 million on a relinquished property and you want to identify a maximum of 3, those 3 properties cumulatively have no limit. So if you want to buy for 40 million or 80 million or 120 million, that's okay, because you don't have more than 3 properties on your list. But the minute you move your list into that 200% identification, now you're limited to 2 times the sales price of what you sold. And if you're selling multiple properties, it's 2 times the total sales price of all the properties you sold. That's the limit. Now, if I haven't confused you yet, maybe this next part I will, really. The government will make an allowance that if you break the 200% rule, you've identified 4 or more properties, and you've put down all their values, and that value total exceeds more than 200%, then the government says you have one last option. That option is to acquire 95% or more of the total value you've identified. So if you sold for 4 million and you identified for 9 million, you broke the 200% rule. That means off that $9 million identification of all those properties, you need to buy 95% of the $9 million you identified, which will probably be virtually everything on your list. So for us in the big city, we don't really use the 200% rule. For folks who are exiting the big city, and again, farmland or industrial land, or buying buildings in other places, even residential, and they need more than 3 buildings to be able to acquire, then the 200% rule makes sense. But to remember, there's limitations of value on the 200% rule, whereas on the 3 property rule, there's no limitations of number of properties. I'm sorry, no limitations of number of value. It's just a limitation of the 3 properties, and that's why they call it the 3 property rule. That was a mouthful. Does that make sense? I hope the answer is yes. Okay.
Yes,
Any
thank you.
questions on that? No? Okay.
Any questions? No?
Okay. This is a big deal, the reverse exchange right now. What is the reverse exchange? It allows you to close escrow, not open escrow. Close escrow on what you're going to buy first. And then it lets you close a sale up to 180 days later. It's backwards. In the delayed exchange we just looked at, it's 180, you close the sale, you have 45 days to identify, and 180 days to close your purchase. Reverse exchange is just the opposite. You're going to close the purchase first, and then you're going to close the sale up to 180 days later. This is very important. You have to have 2 key factors involved in this reverse exchange. Actually 3. Number 1 is us. You have to have an accommodator that specializes in these reverse exchanges. Why? Because you have 2 major items you have to do. Look at the bottom right side in gold. Number 1, it requires upfront cash or cash and financing. So you have, for you to close a purchase first, where's the money going to come from? You haven't closed the sale. You're going to close a purchase first, because if you don't, you'll lose the property. Does that make sense? So the bottom line is that you want that property. So you come up with cash or cash and a lender. Now, what kind of lender? Doesn't matter. It could be a hard money lender. It could be a swing loan, a bridge loan, a line of credit. You want to get the money from a relative. We don't care. This is not lending criteria. This is exchange criteria. Where the money comes from, whether you borrow it or come in all cash or a combination of the 2, is your business. And the bottom line is that you have to be able to close a purchase with money. Number 2, it also requires that we set up in the gold on the bottom an EAT. That stands for Exchange Accommodation Title Holder. What is an exchange accommodation title holder? It's a corporation that we will set up. Some companies do LLCs. It really doesn't matter, either one or the other. We set up a corporation that will take title to either. Now, stay with me on this. When you close the purchase first, if you're going to take title to the purchase, then we have to take title to the property you're selling the day before you close the purchase. The government will not allow you to take physical possession of title on the purchase while you have ownership to the relinquished property. So these are the options the federal government will give you. We will set up this EAT, Exchange Accommodation Title Holding Corporation, and take title to either the purchased property, the one they're buying first, or the day before they close their purchase, we will take title to the property they are selling. They are not allowed to have both properties at the same time. Why? Because if you buy something and then you sell something and you want to exchange what you're selling into something you've already bought, the government does not allow you to buy property you or your related parties already own. It is a big time no-no, especially from yourself. Now, we'll say, well, I'll give it to, my brother or my kid, or what. Doesn't work that way either. There are related party issues that if we have time, I'll go over with you. But here's the deal. They force us, or they force the taxpayer who's doing the exchange, if they're going to close their purchase first, they're requiring this EAT. That means we hold title to either the property that's being sold the day before they close their new purchase, or we hold title on the day of closing to the new purchase. And guess who's going to make that decision? It's not going to be you. It's not going to be your client. It's going to be the lender. If there's a lender involved, and the lender will not allow us to take title because they're lending money to that buyer. who's acquiring this property in this reverse exchange. So they won't let us take title to it. So in those situations, we will take title to the property that's being sold. Does that make sense? How long can we hold the one that's being sold or the one that's being purchased? The answer is in white, right above the gold on the right side, 180 days. So whichever property goes into this holding corporation, the one they're selling or the one they're buying, whichever one we hold, we may not absolutely hold it for more than 180 days. So the bottom line is that's how it works. Make sense? So that sale has to close at that point. What happens after the sale closes? Well, if your client had to advance money to close a purchase first, money that they took out of their own pocket, well, the government will allow us to reimburse them from the proceeds of the sale. After the sale is closed, those proceeds, but only up to what they had to float to acquire the new property. That makes sense? If there's anything left over, then we need to do a principal pay down on the loan of the new acquisition. The client is not allowed to touch money beyond what they put into because they have to close the purchase first. Does that make sense? So that's how a reverse exchange works. And then ultimately you wind up at the end of the period having the holding of the new property and the relinquishing of the old property, but this time backwards. Are there any questions about this? Because this gets really confusing to a lot of people. And once you get into the rhythm of it and you go through it, then you'll get a better feel for it. We're always happy to make sure your clients have their questions answered. If it's a property they have to have, or it looks like there's going to become a bidding war and they want to make a higher bid, to make sure that they're, and then they have to close the purchase first. The seller is not going to allow them time to close the sale. This reverse exchange then is a perfect example of what has to be done. Or if you're in an escrow, you're selling one property, and then you have a second escrow where you're buying your new replacement property, and your buyer falls out of the one you're selling. How are you going to close the new one? You'll have to do a reverse exchange, or you'll lose that property if that seller is not willing to negotiate with you. If that's the case, then we'll set up the reverse exchange, and you just have to make sure you have enough funds to go into that acquisition. We've even seen some of our clients get the seller of that replacement property that they're going to close first, do a carryback for them for that difference. And when the sale closes, that carryback then will be satisfied, it'll be paid off. There's lots of ways of doing this, folks. We just want you to know this. And you're in the situation with your client where they find the right property and they have to close the purchase first. It is allowable as long as they can close the relinquished property 180 days later, the most, the maximum. Since it doesn't seem like there's any questions on that, I'll just keep moving. There's a hybrid exchange. What is the hybrid? Well, you know what a hybrid car is? Runs on gas, runs on electric. The bottom line is there's a hybrid exchange. How does that work? Let's say I'm selling two properties to buy one property. I'm selling two industrial buildings. I want to take all my employees and put everybody under one roof. Well, in a situation like that, you have to close whichever property closes first of the two properties you're going to sell. You're selling property A, you're selling property B. A closes first. You have to close your purchase within 180 days, the new big one. But you have to close the second sale, property B, before you close the new purchase. So what happens? What if you can't close property B, the second sale, before you close your new up-leg purchase? You can do a delayed exchange for the proceeds of the sale, the first sale, property A, into the new acquisition. And we will also set up a portion of the new acquisition to be part delayed exchange, part reverse exchange for the property B, the second sale, which is to close up to 180 days later. Well, if you were to use the maximum 180 days to acquire and then and a reverse exchange, 180 days to close that second sale, you would have up to what, 360 days to conclude this exchange. That's almost a year. So this hybrid is a really good deal if you have to acquire a multiple of up legs, and you can't make the closings all fall in time. You have to close some purchases first, or you have to close multiple sales and to go into maybe one or two purchases. The hybrid exchange, this is what you need to know. The hybrid exchange combines delayed and reverse together, and we'll be happy to speak to your client, make sure we give them some kind of an idea of what's to be expected based on their closings, what they have to do to perform to make this a good tax-deferred 1031 exchange. Any questions about the hybrid? Okay. Number 3, there's a build-to-suit exchange. A build-to-suit exchange, people ask us all the time, can we acquire a new property, hold back money from the sale to go into the TIs or the improvements of the new building? The answer is no, unless you do this build-to-suit exchange. What is a build-to-suit? Well, it's just like a delayed exchange. You close your sale, and then you take possession of your purchase within 180 days with a 45-day identification period. It's the same thing, except we hold title to the new purchase. So the seller in the relinquished property in a delayed exchange closes the sale, but must close the purchase ASAP. Why? Because we're going to take title to it. We're going to set up like an EAT, an exchange accommodation title holder for this build-to-suit exchange. They, in that 45 days, will identify that property and all the TIs or the capital improvements that they're going to do to that building. So they have to have a laundry list of what they're going to do, or if they have plans, that's fine too. If it's going to involve architects, if it's going to involve any kind of entitlements, permits, we can put that as tenants improvements as part of the proceeds of the payment of this build-to-suit exchange. While we're holding it, the work can be done. Since they bought down, they're holding money back, we can make payments to the building supply, to the contractor, or whoever's doing the construction to build these capital improvements. Like a normal delayed exchange, your client must take title to this property that we're holding within 180 days from the time their sale closed, the relinquished property. So that means they don't have a lot of time to do these buildings. So the second item is, remember I said earlier, if it's a reverse exchange and the lender will not let us take title because they're lending the money to them, not to us. But if you have a lender on an acquisition, this build-to-suit exchange will not work unless you have a lender who will allow us to hold the title of the property and then give that property to them after those improvements have been made, but not to receive the property any later than 180 days. And that's what a build-to-suit exchange is. This is expensive. There's a lot of paperwork that gets done. In both the reverse exchange and the build-to-suit exchange, we put it in one department that we have under our legal department. So you'll be working with an attorney. But the bottom line is, this is really good for people who have some extra cash that want to put into capital improvements into their property. And in this post-COVID market, though, you have to be careful. Will your builder be able to perform? Do they have enough labor? How about supplies? Building supplies can be tough to get sometimes. What about appliances and other types of outside items they have to put into the property? We've even had a build-to-suit where they buy land and then they have a module put onto the property and then bolted into the property as the capital improvement. We've seen that with some mobile type properties or prefab properties that have put together. whether they be steel or aluminum or whatever they have to be. We've been involved with those. You may want to call if you have any clients, you have any questions about that. But the bottom line is, I know this is a little technical, but the reverse exchange and the built to suit exchange are there to help your clients to be able to establish and pay for these things through the proceeds of the relinquished property. One more thing, if you want, we'll let you confer or speak with our attorney there in the reverse exchange built to suit exchange department, who can answer your questions and make sure they can speak to your clients, so your clients have a good idea as to what they have to do in order to have a good build to suit or reverse exchange. By the way, we also do a reverse build to suit exchange, where you can do it on the acquisition in a reverse exchange, that where the building is being built until the sale closes, and you have 180 days to do that, as you just went over. So the bottom line is, there's a lot of information here. It's pretty compressed, but it does allow you to do lots of good things together. Okay.
I have a question on that.
Please.
What would happen, if you're fairly confident that the contractor is going to get everything done in the time frame that you need, and then at the last minute that doesn't happen? What are the consequences?
Good question. Here are the consequences. The biggest consequence is you don't lose your exchange, but any cash that doesn't go into the acquisition is boot. It's taxable. So you can build and build and build, but if there's any cash left over, the exchange is still a good exchange, but it's a partial exchange. That means any cash that doesn't go into the acquisition will be taxed, just like it says in the upper right-hand corner. And it's any 1031 exchange, all the cash has to go into the purchase. If any part of it does not, it doesn't nullify the exchange. It just means that that difference that doesn't go into the purchase, and for your client who's doing a build to suit exchange, the purchase is when they receive title to the property. So any money that doesn't go into the property, the time of reception, then they pay taxes only on the difference that did not go in, but they still have a good exchange. Yesterday, I got this call from this guy who bought a property for $3,250,000. He put some money into it, and now he's selling it for like $5.5 million. He wants to do an exchange, but he can't, because he wants to buy down too much. He wants to buy for like $4 million. I told him $4 million is not going to defer any gain because of all the capital improvements you put into the building. So you're wasting your money having us facilitate an exchange for you, because you're not going to get any benefit of tax deferred, because you're not buying above your basis. And that's something that confuses a lot of your clients, and they need to speak to their CPA. Because for you to do a 1031 exchange, yes, all the cash from the sale has to go into the acquisition, and any debt you're paying off on the sale must be reborrowed. But for those differences, it's got to be a high enough purchase price to justify that paying a company like ours to facilitate an exchange makes sense for them. Or they just might as well just sell and just cash out, take whatever's left over, take their time. Don't wait the 45 days. They can go a lot longer than that and buy a piece of property later. They won't get any benefit of the exchange, but they can't if they're buying too low. And that's the whole purpose of the cash going in, the debt replacement. Kim, did that make sense?
Yes.
Okay.
Bill, 3 minutes.
Manny, thank you. Thank you for letting me know. Let me go over this really fast in 3 minutes. Remember, non-recurring closing costs can come from the sale. What is that? You can, without having to replace this, you pay for commissions. The seller pays for commissions. Transaction coordinator, escrow, title insurance, transfer taxes, including the ULA tax that is allowable to be paid for out of the proceeds of the sale. Recording fees, 1031 exchange, our facilitator fees, and any contractual agreement that the seller and the buyer made. So if the buyer requests the seller to perform this, this, and this, and it costs the seller money, and it's a contractual agreement between seller and buyer, the seller can say yes, pay for it out of the proceeds of the sale. That's new money that they don't have to replace now, because it is a cost to sell, a one-time non-recurring cost to sell. Here's a little blip of what it looks like, $1 million sale minus what we just spoke about, number 2, the non-recurring closing cost equals the new purchase price of $930. Some people say you have to buy over $1 million if you sold for $1 million. That's really not true, because you're allowed to take out the one-time non-recurring cost to sell. That does not have to be replaced. That means you have to buy for $930. If you have a cumulative payoff of $400,000 of debt, that leaves you $530. We hold the $530. We put it into the acquisition of the new property. They reborrow the $400,000 difference. Number 4, $400 of debt replacement plus $530 of cash equals the $930. So how do you get that debt? Get a new mortgage. Put in new cash instead of borrowing. The government will let you do that. Seller can carry back for you. You could assume the seller's loan. I just recently got a guy who's going to assume a loan in his 1031 exchange because the seller's loan is 3.5%, and he had to pay 6.5 or 7% for purchase money. So he was better off just assuming the seller's existing debt. It was assumable. You could actually take it subject to, or any combination of the above, as long as you replace all the debt and you replace all the cash. You know, there's a lot of other things we can talk about on these pages. I think that would make, maybe we're going to have to do a part 3 next time. But I really appreciate your bringing us in. If any of your agents want to be able to get some of this information or these marketing letters that I have that talks about the rate of return of investment. Remember, we said the higher the equity, the lower the rate of return. And the reason why it's lower, because they can't charge more rent because they have more equity. Their rate of return is going down. There's flyers and marketing pieces like this. If you want, send me an email or call me, philatwan@gmail.com. If you want the actual letters, if you just want to call me, you have a question, 213-479-8800. But many, I appreciate you. I appreciate Kim. I appreciate all the education you're giving your agents. Not every brokerage does this. Believe me, I know. I've been doing this for a long time. And continued success in 2023 as we dive into February and go straight into the springtime. I hope all of you can create new listings, and hopefully ULA will be defeated in some capacity. But thank you all. We appreciate your help.
Yeah, thanks, Phil. As always, you're a great speaker, and always abundance of wisdom and information. And you know, hey, you've been doing this for a minute or two, so you're definitely the expert, right?
Maybe 3.
Yeah, we call it in KW, we call it mastery, right? Like you master a skill, and it's something that, you know, we don't take for granted. So thank you for your time, for, you know, sharing that information. Kim, definitely scheduled for second quarter, Phil Atwan part 3. We're gonna keep doing that, because you know, it's better to do it in small portions so we can digest everything, and then, hey, go and research more, read more, reach out to you and one another, and have that again, that all that data kind of retain in our brains. But that's awesome, Phil. Thank you as always. Amazing information. We have, you know, we kind of hit the 2 o'clock, but I do want to, you know, have maybe a couple of minutes. We do have Jason Default. He's our regional ambassador for the coastal region. He's the, you know, plugged straight into KW Commercial International, the division, the headquarters. Jason, any kind of updates, just a few things you want to share?
You know, just a few updates. Thank you. We are going to have specialty training, different asset classifications. If you're interested in that training, let me know. I'll send you the links for those through our educational platform. And if you know any, you know, new agents that are coming, our nucleus training starts in March. So the training is pretty good. That's a good start. KW is doing a good job of updating and becoming more valuable to us internally, and to you know, anybody trying to get into the business and landing a home here at KW. So I'll keep you updated on as new things are turning. There are a lot of moving parts, but we're looking forward to a 23 looking pretty fruitful.
Awesome, Jason. Thank you. And yeah, do
you.
share with Kim, and we're gonna put on the on our channels, the KW commercial group as well. Thank you. All right, guys. Well, thanks again, everybody, for showing up. This is recorded, so we're gonna share the recordings, and also we're gonna share Ray Rodriguez with Lucrum Group, his recordings of their interview with Jarvis regarding the that new tax law, the transfer tax law. See what they're had to say. So that will be interesting watch as well. So take care. We're gonna see you guys in 2 weeks from now in our next commercial session. Take care, everybody.